Hi, welcome back to another edition of Flippers Fund Flows Insight. My name is Tom Rosine. Thanks for joining me today. I'll be reporting flows for the traditional fund business initially. We'll talk about ETFs as well for the week ended August 26, 2015. I think many people will be surprised if I said, hey, we saw inflows. About $7.6 billion net new money came into the conventional fund business, but the headliners are always caused by weird things. This time it was because of money market funds. We'll get to that in greater detail in just a second. It's the fourth consecutive week, though, that we've actually seen plus side inflows into the conventional fund business, despite having everything kind of fall off the cart, wheels coming off the cart. Again, the headline news is a little bit deceiving. If we take a look, concerns about global growth, the yuan devaluation, Chinese market just derailing. Actually, the Hang Seng was down almost 23% in just this 1 week period, and also decline in commodities all the way up until just today. Actually, we've seen a little bit of increase today. Pretty much led us to this doubting Thomas type of number. I gave you 7.6 billion in, and we'll see why that actually occurred. But at the end of the week, and we'll just get to that right away. End of the week, we actually saw better than expected economic news, which kind of popped up and gave some of this back. But again, I'll give you details as we go. Let's take a look at our macro group. Macro groups for the equity group basically saw about $2.6 billion in outflow. Taxable bond funds saw about $4.7 billion out. That's pretty big, and both of them are negative. That's kind of unique. Muni bond funds saw about $406 million in outflows, but here's where all the money came in. A lot of people ducking for cover, still putting money back to work, though, in the conventional fund business. About $15.2 billion net new money coming into those coffers. Let's take a closer look, though, at each of these groups one by one. Equity funds are kind of the unique area we'll focus on. Down 6% for the week. That's Wednesday to Wednesday. It's the third consecutive week that we've seen downside performance. And also, we saw about $2.6 billion, as I said, roll out of those coffers. It's the second consecutive week we've seen outflows. And how it broke out is domestic equity funds gave away the majority of it. And again, it was just a little bit over the majority. $1.4 billion. Seventh consecutive week they've seen outflows. But if we take a look at non-domestic, for the first week in six, we've actually seen outflows, and it was $1.2 billion. We got to keep in mind that over the last several weeks, despite all these news in the international market, slowing growth, Puerto Rico debt, Greek crisis, and all the rest, we saw basically inflows into this group. This is the first week we've seen outflows from this group. If we break these out into kind of detailed areas, we see that mid-cap funds on the domestic side and large-cap funds saw outflows about $0.5 billion and $0.4 billion respectively. However, here's where some of the money had big flows. International equity funds saw about $1 billion out, and emerging markets saw about $1 billion out as well. So this is what was happening. A lot of people were finally starting to run away from the international markets while at the same time still getting rid of some of their domestic equities. Let's take a look at the ETF market and see what happened in that group as well. So for the first week in three, we saw about $15.2 billion. The first week in three, we saw negative numbers, but again, $15.2 billion was the exodus. It was the second largest on record, and we saw the fourth largest on record, and it was the largest since August 6th. 2014. iShares Russell 2000 actually took in some money, about $467 million. iShares MSCI USA, minimum volatility, anything that had a volatility name or gold in the name, because again, safe haven plays or anything that was contra to the crash was going to get some money in, and it did. $342 million for the minimum volatility fund. And then if we take a look at the bottom side of this event, we saw Spider S&P 500 actually lose the lion's share of this, $4.3 billion, and then Spider Dow Jones Industrial Average ETF lost about $1.1 billion. So that was quite a story as well. So this is kind of one of those weird things where we've seen really a big response from our authorized participants taking some of that risk off the table. Let's see what happened on the fixed income side, and that's a news story as well. For the fifth consecutive week, we've seen outflows out of this group, $4.7 billion, third consecutive week that we've actually seen this type of outflow. And then for the third consecutive week, we saw a 1.74% decline. It's a big decline for fixed income funds. And again, so this is where we saw kind of both equities and income. People are a little bit concerned on the equity side, obviously because of China, but also they're still concerned about some of the Fed rhetoric out there, and so they were afraid interest rates are going to increase, and we saw some big outflows. Where the group that took in money, we have government mortgage funds. I saw about $452 million of net inflows. We saw government treasury and mortgage funds take about $270 million in, while on the downside, where we saw some of the big money out, corporate investment grade debt funds saw $2.2 billion leave their coffers, and it's the largest net redemption that they've had since October 2008, and that, by the way, was the second largest redemption from this group on record. We go all the way back to the 90s in this case. Let's take a look at our ETF group and see what happened there. This is one of the areas where ETF authorized participants, remember I told you, took risk off their portfolios on the equity side. Fixed income, they actually added to their portfolios, $2.1 billion. Second consecutive week we've seen inflows. iShares short Treasury bond ETF saw about $1 billion in net inflows, and the iShares 1 to 3 Treasury bonds saw about $500 million of net inflows coming to their coffers. However, on the bottom side, again, getting rid of that risk. iShares iBoxx high yield corporate bond funds saw about $323 million in net outflows, so it wasn't really that big of a deal. But again, here's something kind of new for us, is that we're seeing some big flows by authorized participants into the fixed income side. And again, they're usually trying to front run us because they're providing product and services for us to buy. And they had to anticipate that people were going to be doing some runs for short Treasury and Treasury securities, and certainly that happened. Let's take a look at our muni bond fund group. There we saw about $406 million outflows. It's the fourth week in 5 that we've seen outflows. Ironically, though, this is the 5th week in 6 we saw positive returns, 0.07% return. Not anything to talk about, but it's just, again, ironic that we'd have 5 weeks out of 6 having positive plus side returns and still seeing kind of this outflow happen out of this fixed income part of taxable, tax-exempt universe. Again, a little bit of a head shaker. National munis saw about $285 million in outflows. It's the first week in 3 they've actually seen outflows. So again, there was just some concern over there. People were just not going to wait for any interest rate increases. They were not going to wait for another shoe to drop, and they got rid of their risky portfolios, went into money to hide. Let's take a look at money market funds. Natural transition to that. 4th consecutive week, we've seen inflows, $15.2 billion this time. How it broke out is that we saw taxable money markets taking about $15.1 billion, and tax-exempt money markets only taking about $100 million. So that brings us to our 15.2. However, if we take a look at this, both groups, institutional investors, $11 billion even on inflows, and we saw $4.1 billion on the retail side. So certainly, investors on both the institutional side of the market as well as the retail side of the market saw a need to stash money away. They're still, not sticking underneath the mattress. They're putting it in mutual funds, but they put it on the sidelines for, hopefully, I'm assuming, a bounce. We've had some big moves, again, 6% on equity funds just in that 1 week period of time, and just in the last couple days, late on Wednesday, Thursday, and Friday. So Wednesday and Thursday, positive returns and just minor downs, if not a slight positive for like the NASDAQ and a few others on Friday. So that brings us to the end of our conversation. Basically what we're going to be looking for is the news and how it impacts our investors as we go forward. Again, kind of a ho-hum day here on Friday evening. But if we take a look at it, basically we saw some good economic reports. We saw durable goods order come in a little bit stronger than expected, actually a lot stronger than expected. And income and spending were both on the rise in July as well. So those were positive. So we can take some of the good economic news, put that back to work, along with almost, in most of those markets, 10% corrections as far as the drop. I think people are going to see some buying opportunities, and certainly we'll be able to take a look at that next week. If you want to do a deeper dive, though, into some of the areas that I missed, please go to our website at www.lipperusfundflows.com. If not, I'm sorry, at lipperusfundflows.com. If not, join us next week when one of our analysts will be talking to you about flows and what they meant to them for that particular week. Thanks for joining me. My name is Tom Rosine, wishing you the best in your wealth planning and creation.